Good afternoon, and thank you for tuning in today's live webinar concerning the topic of the FCA's capital adequacy regime. I am David Jarman, I head up the financial services team here at Buzzacott. The current pandemic has led every industry and business worldwide to assess how they will be impacted over the foreseeable future. For the UK financial services sector, rules introduced after the banking crisis have arguably put regulated firms in a better position than those operating in other industries. Capital buffers, additional risk capital, and detailed business continuity plans have allowed most to better adapt and react to a very different world over the last 2 months. Whilst the specific ramifications of COVID-19 may have been hard to predict, the impact that a market crash or a major disaster are scenarios commonly built into risk mitigation plans and ICAAP documents. It is certainly interesting to see that those who have previously gone through a more thorough assessment process have typically been better prepared. During today's webinar, we'll be having a recap on the capital adequacy regime, how it impacts different types of categories of firms, and emphasising the areas that require closer attention at the moment. We're giving an overview of the FCA's stance during the pandemic and touch on some of the key announcements made recently. Finally, we'll also cover some of the tax considerations that are likely to be relevant when considering the capital structure of a regulated business. My role is to now hand over to our experts and for the next 40 minutes or so, stop my dog from barking, hope Amazon don't deliver, pray the Wi-Fi doesn't fail, and try to prevent the phrase "you're on mute" being repeated too many times. And so to our speakers, we have Priya Mehta, who heads up our award-winning FCA advisory and reporting team. She is joined by Jonathan Asiraltham. They and their colleagues have spent much of the last few weeks helping our clients not only meet their ongoing reporting obligations, but also providing advice on calculating future capital requirements. Antoine Housen is our head of FS Tax and will be covering the tax topics that he sees as key when looking at capital structures and business plans as we emerge from the lockdown. Behind the scenes, I'd like to thank Becky Maycock, acting as a webinar producer and controlling cameras and PowerPoint slide over the next hour or so. We are live and I believe questions can be posted during the webinar. I'll try to address these as they come in, but if we run out of time, we'll follow up after the session. So if we can come to you, Johnny, first. How are you? To start, do you want to talk us through how the capital resources are calculated and the different types of requirements that apply to different categories of authorization?
Yeah. Thank you, David, and good afternoon, everyone. I hope everyone is safe and keeping well. So just to go through the general requirement for all regulated firms is to ensure that they maintain sufficient financial resources so that they can meet liabilities as they fall due, and most importantly, to protect consumers. Now, in order to assess whether firms have enough financial resources, firms need to calculate their capital resources available in accordance with the relevant accounting standards. The capital can take various forms depending on its quality and permanency. For instance, common equity tier 1 or tier 1 capital would usually be made up of either fully paid ordinary shares, share premium, audited P&L, or members' capital for LLPs. So generally, tier 1 capital would have the following characteristics in that it is able to absorb losses, it is permanent or available when required, and it has no fixed costs attached to it. As you can see, there are the tiers of capital, but just do be aware that these are restricted to a certain percentage of your tier 1 capital after deductions. So, for example, your tier 2 capital is limited to 50% of your tier 1 capital. So, in arriving at the total capital available, firms need to determine whether any deductions need to be made. For example, material interim losses incurred to date, negative reserves, or goodwill. Particularly for LLPs, it's important to note that excess drawings over profits available need to be deducted as well. So while these are included on the balance sheet as an asset, they are reliant on the business making sufficient profits to cover these and so need to be deducted. So once this has been calculated, the total then needs to be greater than the firm's overall capital requirement. So just moving on to the next slide now, I'm just going to go through the different types of investment firms and an overview of their corresponding capital requirements. So to start with, the categorisation of investment firms is dependent on the regulatory permissions it holds and therefore the activities it carries out. That in turn will give each type of firm a base capital requirement that must be maintained at all times as an absolute minimum. These base requirements reflect an increase with the level of risk that the firm is taking in its activities, ranging from €50,000 for exempt CAD and BIPRU firms to €730,000 for full scope IFPRU firms. Moving on, we're just going to touch upon the Pillar 1 capital requirements, which again increase in size and also complexity as the risk levels increase. So to start with, exempt CAD firms just have a capital requirement of €50,000. BIPRU firms and IFPRU limited license firms, so there's 50k, 125k and 730k firms, have a similar methodology in that their capital resources must exceed the higher of the fixed overhead requirement, or FOR, or the sum of the market risk and credit risk capital components. CPMs or CPMIs under AIFMD need to calculate an FOR as part of their capital requirement. And additionally, their requirements are based on a component of their funds under management. For full scope IFPRU firms, while not having to actually calculate the FOR as part of their requirement, they have a more complicated calculation in that they need to add on the operational risk and concentration risk, also known as large exposure risk, capital components to their calculations. And then just finally, for BIPRU, CPMI and all IFPRU firms, they are all subject to ICAAPs and the Pillar 2 assessment, as well as having the requirement to make their Pillar 3 disclosures available publicly on an annual basis. So I'm just going to move on and give you a quick overview of the various risk components that different types of firms have to consider in order to calculate their capital requirement. And the following diagram is quite useful. So for most firms, credit risk and market risk need to be calculated. Credit risk is a measure of the risk of defaults of a firm's receivable asset balances. And this is typically at 8% of the risk-weighted assets. And then market risk assesses the firm's assets and liabilities and the risk of loss due to market fluctuations, such as movements in FX rates. Full scope IFPRU firms need to calculate operational risk, which is often based as a function of the firm's average turnover for the last 3 years, and also concentration risk, which is the risk of a firm's exposure to a single particular counterparty. So although not applicable to full scope firms, as you can see, the diagram does highlight the importance of the fixed overhead requirement to a lot of the investment firms and our clients.
I guess just on that point, I mean, most I guess most of our clients that we see the FOR, the fixed overhead requirement, as the key determinant. Can you give us some background on the key things to remember when calculating this?
Yeah, thanks, David. I mean, to answer your question, it's worth going over the definition of the FOR, which is basically calculated as a quarter of relevant fixed expenditure. It's worth noting that the definition is generally similar for BIPRU AFIRMs and IFPRU firms. For established firms, the starting point is typically the total annual expenditure as per the latest audited account. Firms can then elect to make a series of deductions for non-recurring or non-guaranteed costs as per the following list. For example, staff bonuses, profit shares, or one-off structural costs. In the current climate, I think firms have the ability to adjust the FOR if there is a material change in the run rate to date. Now, practically at the moment, we are seeing firms trying to reduce costs such as rent, staff costs, and maybe reducing their marketing spends. Now, while reducing costs in the short term may result in material change to a firm's fixed overheads, firms should really be considering whether or not this is just a temporary reduction, in which case it may not be relevant to deviate from the amount calculated as per the latest accounts. So firms should really only be reducing their FOR where there is a permanent reduction in the cost base of the business. On the other hand, where firms are adjusting their FOR, particularly downwards, they should make sure that they document these calculations and review and update their forecasts accordingly. It's just also worth mentioning that for if-proof firms, the CRR does stipulate that if the calculation does change by more than 20%, firms should adjust their fixed overhead requirements accordingly.
Yeah, I mean, I think it is important to distinguish between temporary and permanent, and I guess, like you say, if costs are going down temporarily at the moment, then that doesn't necessarily lead to a reduction in the FOR. And we've actually just had a question through on furlough payments, actually, and how they are treated, which I guess they don't necessarily reduce the salary cost, and certainly not permanently.
No, that's correct. I mean, the grant is treated as income, but firms are still contractually obliged to pay their employees, and this cost is still recognised in the P&L as a fixed expense. So, and also, as you said, the grant is actually a temporary measure in any case. So once the furloughing period has ended, it'd be expected that the firm's net cost would go back up, and therefore this wouldn't represent a permanent reduction in costs or indeed the FOR.
All right. Okay. Okay. Thanks, Johnny. So that's pillar one. So I'm just moving on to pillar two, Priya. What are the pillar two obligations that most firms face?
Thank you, David. Good morning to all our UK-based clients and contacts on the call today, and good morning to all those who have joined us for this webinar from the US. I do believe that looking above and beyond the capital adequacy calculations is not just important in the current scenario, but actually the expectation as well. And it is more important than ever before to identify and assess all risks from an operational and financial perspective. Some of these risks would have actually materialized in the past few weeks. So, I mean, sort of general questions in terms of how did you handle them? What actions did you take to control damage? Who made the key decisions? Was there any monetary impairment or additional spending because of any of those risks occurring? So the key message from the FCA in the last few weeks relates to being able to demonstrate financial and operational resilience. Yes, of course, they've extended the deadlines for some of the FCA returns to allow firms to collate the required information as accurately as possible. But this does not mean that the regulator is less vigilant or less interested in any of the information that you're supposed to send them. And in fact, as a firm, you must ask yourself, have you done adequate analysis and documentation of your risks to ensure that you will not be in a precarious situation should the FCA look into your compliance or operations at the moment? So with that as a background, I want to talk through 4 crucial elements today of a complete Pillar 2 assessment. Of course, bearing in mind that a formal Pillar 2 assessment is not applicable currently to exempt CAD firms, but some of the points I want to talk about could just be classified as best practice from a robust business continuity planning perspective. So in my opinion, all firms must take note of this. First and foremost is the preparation of realistic financial projections for the next 12 months at least, as granularly as possible, and compare them with the actual results on a month-by-month basis. Use these projections for a detailed estimate of capital adequacy, so you roughly estimate when the next capital injection may be necessary, taking into account any expected losses during the year. The requirement under Gen Pro 1.2.26, if I were to just quote it, is actually firms must at all times maintain overall financial resources, including capital resources and liquidity resources, which are adequate both as to the amount and quality to ensure that there is no significant risk that its liabilities cannot be met as they fall due. So this actually puts an ongoing responsibility on you to monitor your position and have measures in place to ensure that no breaches occur. So as a tip, I would suggest increasing the frequency of monitoring your capital adequacy position. The next point would be extending these best estimate projections into stress testing. stress test what your capital and liquidity looks like if your revenue is halved or if you didn't have any income at all for the rest of the year. How long would the business be able to carry on? Think about the worst case scenario. The key requirement here is not just to throw open the scenario, but to articulate how the senior management would fix it. So what remedial actions would be necessary? I would strongly recommend at least 3 or 4 scenarios to be stress test. At an operational level, you may want to consider what if there's a massive trading error or a cybersecurity breach. And in fact, just to mention one of the consultation papers that the FCA had issued last year on assessing adequate financial resources, the consultation paper clearly stated that firms must consider what if scenarios and estimate the potential impact. This is to determine that the amount and type of financial resources needed to be put in right when things go wrong. The next step, and arguably the most important one, is to construct a risk register or a matrix which clearly articulates the likelihood of occurrence of all types of operational and business risks, specific controls in place to handle them, identifying senior managers with ultimate responsibility for monitoring and quantification of capital required to cover those risks. This actually drives the core Pillar 2 capital framework, and the FCA expects firms to have documented this diligently. From an operational perspective, firms should examine their current infrastructure, resources, or third parties upon which they're heavily dependent. It is essential that the firm's agreed qualitative and quantitative risk appetite and risk thresholds are reviewed, and the relevant compliance monitoring and reporting processes are in place. And the last element for the Pillar 2 assessment would be wind down planning. Not many firms actually use the wind down planning guidance that is within the FCA handbook, which sets out its expectations from firms to document the process they intend to follow for an orderly wind down. We're certainly not suggesting to wind down businesses, but just highlighting an expectation to have a written plan in place. The guidance actually states that that besides having a clear-headed and prompt decision-making ability, it is important to articulate a wind down plan at an operational level. So obviously the starting point of the wind down would be the decision, and the end point would be the successful cancellation of your regulatory permissions. But the planning is all about the numerous tasks and challenges in between. So typically a good wind down plan would give a clear picture on governance process, operational analysis, estimated revenues and costs during the wind down period, and the required resources.
Okay, thanks. Yep. Just on that point, the question that we have coming in, where do the Pillar 2 requirements fit into ICAAP documents, and are you seeing everyone revise their ICAAPs at the moment?
This actually reminds me of a conversation I was having with a client just a couple of days ago who did their whole ICAAP assessment, and then they're actually looking at updating a few things in their ICAAP at the moment. So yes, you could arguably say that all of this is covered in an ICAAP. So what is Pillar 2 assessment beyond the ICAAP? I think the main thing is timing. If you look at if you're a December year end, then you would most likely have started your ICAAP update process from, let's say, October or November of 2019, and most likely wrapped it up by February, which definitely means that you wouldn't have addressed the risks relating to the pandemic in your ICAAP. If you're a March year end, then probably your ICAAP process is open at the moment, but it needs to go a lot more in depth than just rolling forward last year's ICAAP. More importantly, assessment of ICAAP is expected to be an ongoing process, so it does so that it has to discuss the current impact as well. If the FCA asks to review your ICAAP anytime during the rest of the year, they will expect it to have been updated for the risks faced by the firm due to the pandemic. And just as I mentioned, ICAAP for completeness purpose, it is essential that you have clearly articulated the governance in place, the senior managers who have to take responsibility to ensure that all elements are in order. And obviously, without opening another plethora of requirements under the SMCR, it must tie back to the statements of responsibilities of senior managers, someone in the firm must have put down on their statements of responsibilities that I am responsible for capital adequacy. Under SMCR, one message that the FCA kept reinforcing was reasonable steps. Senior managers being able to demonstrate that reasonable steps have been taken to control any situation. And this event really calls for it. Also, contingency funding gets usually discussed in an ICAAP, which in the current scenario may become something that firms are actually compelled to tap into. So worth reviewing your ICAAPs as we go along.
Yeah, and I think just to add to that, and I think anyone that's gone through an audit recently will realise the importance of demonstrating going concern and the going concern disclosure within financial statements. And certainly, if you haven't gone through the audit yet for your March year ends, then it's something which certainly the projections and the ICAAP document will all add to the evidence that's needed to demonstrate the going concern basis of preparation. So thanks for that, Priya. So Johnny, the difference between capital and liquid assets often requires clarification. People often think, that if there's plenty of money in the bank, then they're fine from a capital resources perspective. But again, there is a difference. And can you talk us through the definitions?
Yeah, thanks, David. Yeah, absolutely. I mean, there is, as you say, there's a lot of confusion sometimes with between capital and liquid assets available. I mean, as we've already mentioned, Tier 1 capital needs to be able to absorb losses, needs to be permanently invested in the business and have no fixed costs attached to it. Liquid assets, on the other hand, are cash and assets that can be converted to cash quickly if needed to meet financial obligations. And they're defined under MiFID as assets that can be converted into cash within 90 days. Just a point to note is under AIF&D, these assets would need to be cash convertible within 30 days. So the confusion does arise in quite a few cases where firms have a lot of have sufficient cash in the bank, but they don't necessarily realise that this doesn't necessarily correlate to the firm's capital resources. For instance, they could have large creditor balances by deferring tax or PAYE payments in line with the government schemes, or even loans on the balance sheet that would reduce the cash balance once paid. Firms could also have significant unaudited profits and realise the cash for these, but again, these do not qualify for as regulatory capital. On the other hand, you may have, while capital may be put into the business to meet its working capital and regulatory capital requirements, it can often be tied up in illiquid assets such as fixed assets and deposits. And again, it should be also noted that goodwill, while it sits on the balance sheet as an asset, is also deducted for the purpose of calculating the firm's regulatory capital. From the Reg Cap side, I think some firms have issues where they may have had a good year, and while they may again have significant cash balances, they can find themselves in a breach position, albeit temporarily. For fund managers, a large performance fee at the year end could trigger a spike in both credit risk and market risk, which can cause a temporary capital adequacy breach. So firms really need to be actively looking forward in order to avoid such situations. Another common issue that we come across quite regularly is regarding shareholder member loans and contributions. Firms can find themselves in breach positions even though they may have thought they'd put cash into the business, but they may not have prepared the correct documentation to authorise that capital issue. Therefore, the transaction would sit as a loan on the balance sheet and not qualify for regulatory capital. Another point to note is that it's very difficult to backdate intended capital issuances after the transactions occurred, especially for limited companies. So I think the overriding message is, while cash is obviously vital for all firms, it does not necessarily equate to regulatory capital. So firms should be proactively monitoring their capital and cash positions together going forward, even when they may have had periods of good performance.
Yeah, and I think that's the certainly with liabilities such as VAT and PAYE at the moment that HMRC is allowing for people to defer. It doesn't doesn't remove them as liabilities on your balance sheet. So I guess that's something else just to bear in mind when looking at your liquid assets. So what's the role of the regulator been? So Priya, just to move on to the next slide. We've seen advice on the financial resilience. We've seen advice come out on the financial resilience with the FCA emphasising the need to plan, conserve, maintain, assess, and update, which is, I guess, is why we're here to help, really. And I think this slide probably reflects the wider stance quite well. The communication from the FCA can largely be categorised to reflect the role it has played in protecting the consumer, supporting authorised firms, and perhaps an additional box might be titled helping Boris and Rishi as the implementation of various COVID-19 schemes have required the FCA's assistance. Is that a fair assessment?
Yeah, it is a fair assessment, and I think overall the FCA have been very supportive in taking proactive steps to reduce burden on firms and to help them protect business and consumers or investors in general. Everything we have on this slide, there are specific measures taken by the FCA to protect and assist regulated businesses survive through the storm. Life has gone tougher, budgets have gone tighter, remote working, loss of human connection, pause on new products, new opportunities are just some of the very basic practical impediments in 2020 that were never anticipated, not to mention any personal issues that individuals could be facing. So it helps to know that some of the reporting deadlines are extended. A lot of additional legislation that we would have been dealing with right now has been pushed into the future. Larger firms who are required to maintain capital buffers on top of their Pillar 1 and Pillar 2 requirements are temporarily allowed to dip into their buffers if need arise. The FCA have also said that if you're facing any financial difficulty or likely capital adequacy breach, then you must contact them as soon as possible, and they will consider each firm on a case-by-case basis to see how best they can accommodate. What we've done on the next slide, we've listed all the announcements made by the FCA over the past 8 weeks. I've basically picked up every announcement that has been made with context to a solo regulated FCA firm in the investment management sector. I've omitted everything published for insurance or mortgage consumer sector because it's not relevant for our audience today. I've also not included announcements made by the PRA, Bank of England, ESMA, or EBA, but we are separately tracking them and will communicate them where necessary. Obviously, I won't go through the whole list, but just a few things I wanted to touch upon. We've discussed the regulators' expectations around resilience in depth. I wanted to just sort of explain an announcement relating to expectations under SMCR. Whilst it is expected that all prescribed responsibilities are duly discharged, the FCA have now temporarily introduced modification by consent notification. It will be in place till April 2021. It allows you to arrange a cover for senior manager for a period of 36 months without being approved. This is, of course, if a senior manager is absent because of coronavirus or you are unable to recruit an appropriate senior manager because of the pandemic. But please continue to document any reallocation or amendments of senior management or prescribed responsibilities by updating the SORs and the responsibilities map. The other update, which is worth noting, is professional qualification exams. Since most of the accredited bodies and professional qualification providers have cancelled exams, most of them with no specific arrangements in place to reschedule them, the FCA have extended the 48-month requirement to 60 months. However, they have insisted that they expect all employees to have the skills, knowledge, and expertise needed to discharge their responsibilities. Although no action is likely to be taken against any firm, the FCA will want to see that best effort has been made to seek alternative arrangements. I suppose this just goes back to the reasonable steps requirement for senior managers. And lastly, if you handle client money, then there are several leeway and alternative measures to be put in place in relation to handling of checks, depositing client money, notification of cash breaches, and and completing your CAS audit itself with your auditors. More than happy to discuss this offline for whoever that's relevant to.
I knew I'd do it. So what about future plans? So again, back in January and February, talk was all to do with new regulations, I guess, imminent discussion papers, and dare I say it, Brexit planning. I assume most of these have been delayed now.
Yeah, I think we can expect the FCA to publish some guidance relating to their expectations as the Brexit transition period is set to end in the next 7 months or so. I think most firms have done their Brexit planning in 2019, to be honest. So it's probably sitting in the sidelines or perhaps looming larger than ever. Brexit conversation is restarting as we see it generally, although a lighter topic than what it was once. We're also hearing about initiatives in the industry where a lot of DGQs or other due diligences had Brexit painted over them all over, which is now being replaced by how firms would handle pandemics. So I think contingency planning for the future is the other area where we can expect the FCA to throw some light very soon. Firms could be expected to have a contingency plan in place to address responses to the risk of relapse and what is the trigger point in case we see a second wave of the virus. Also, we might see some updates relating to planning around how your employees will return back to work, the health and safety measures that will need to be in place, and the operational and logistical issues to be handled. So watch the space. In terms of the actual sort of regulatory updates, what we have on this slide here is literally everything that the FCA said that they will not publish now and they'll leave it for the future. As you can see, they have said, this is literally an extract from the FCA's website, and as you can see, they have said Q2 2020 on a lot of things. We haven't yet seen any of the publications getting sent out. But one thing I wanted to bring to your attention is prudential requirements for MiFID investment firms. This is the Investment Firm Regulation and Directive, IFR-IFD. Now, although the timing of this is slightly up in the air, the point to note is that this will bring about significant changes to capital adequacy rules. The K factors which you need to calculate as part of the capital requirement, depending on the classification of your firm, are quite complicated. Also, when I talked about the Pillar 2 assessment earlier on and said that it does not apply to exempt-CAD firms, well, this regulation brings it into force for exempt-CAD firms as well. Base capital requirements go up for most firms. Fixed overheads requirement becomes the minimum methodology of capital requirement calculation for most firms. So it is a complete overhaul of capital adequacy rules. In an ideal world, a lot of our clients would have had to prioritize this at the moment, and we would have been working with them to help them comprehend this regulation. But this has taken a slight back foot because of the pandemic. So again, a space to watch.
Yeah, I mean, it certainly was the hot topic that we were gearing up for and assessing the impact. I mean, has there been no announcements on firstly, when was it meant to be introduced, and has there anything been announced on a deferment of that effective date?
There has been no announcement from the European Commission, who had initially stipulated the date as June 2021. So that date still stays. But taking COVID-19 out of the equation, we were expecting FCA's consultation paper in Q4 of 2019, which got pushed into 2020, and now obviously it's not out yet. As I said, the ultimate date of implementation has not yet changed. So if not Q2, we should see some clarity from the FCA in Q3. But just considering the changes that this regulation will bring, it is a really good idea to start thinking about the impact assessment. So, I mean, overall, to summarize the FCA's message, just reinforcing it, is to plan ahead, conserve capital, maintain capital adequacy, assess liquidity, and update your ICAAPs and wind down plans.
Indeed, and speak to your advisors as soon as possible. Thanks, Priya. Antoine's been waiting patiently, and perhaps we can now turn to taxation and how this might inform decisions concerning capital adequacy structures. Antoine, what are the key considerations for financial services businesses?
Thank you, David, and good afternoon to everyone. Thank you for joining us this afternoon. In my mind, there are two overriding options in play when focusing on the tax considerations arising from capital adequacy. The first is the capitalisation for group, subgroup, or a particular entity in question, and the second is the pricing policy of the group. So given that we're focusing on our UK FCA regulated entities, these are often either UK incorporated and resident companies or LLPs. If we look at the first of the two options that I mentioned, whether or not to capitalise these entities to maintain capital adequacy for regulatory purposes, typically this is going to be done via equity or debt financing. If capitalisation is effected in the form of equity into a UK resident company, for instance, any dividends would be paid out of post-tax profits. So although no deduction would be available for UK corporate tax purposes, no withholding tax would be levied on dividend distributions. If, however, capitalisation is effected into a UK resident company in the form of debt, then assuming the financing cost is on arm's length terms, the corporate tax deduction at 19% should be available for the financing cost, but withholding tax may need to be levied at source at 20%. In both circumstances, it's going to be important to determine, who the investors, who the shareholders are, and the nature of their tax profile. For instance, if they're non-UK tax resident, then they may be able to access treaty relief to reduce withholding tax that may otherwise be levied. A further point to consider is the UK tax resident but non-UK tax domiciled individuals, so non-doms, may have been reliant on the remittance basis of taxation for income tax and capital gains tax purposes. We have numerous FCA regulated clients with principals who are non-doms who are going to need to take care, potentially remitting sums into the UK if they're capitalising the UK operations, because it could crystallise UK income tax and or capital gains tax liabilities. Also vital to the capital adequacy discussion is understanding how the UK FCA regulated businesses generate their revenues and whether they're going to be profitable or loss-making based on their current pricing policy. Key to this, of course, will be understanding the complete value chain of a group and the UK FCA regulated entities' relative value within that group, so as to determine how revenues are shared between group entities. From a UK tax perspective, intragroup transactions entered into will typically need to be transfer priced to ensure the UK operations are remunerated on arm's length terms, and effectively commensurately with the UK activities undertaken. Often groups use a revenue or profit split transfer pricing methodology, which under normal circumstances would ensure UK operations are suitably profitable, but capital adequacy problems, of course, can arise when a group overall is loss-making, and the UK FCA regulated entity may only be entitled to a share of revenues that give rise to losses in the UK. So there can be temporary solutions to capital adequacy issues that may arise. So, for instance, temporary change in transfer pricing policy to a cost-plus pricing methodology or similar. It's certainly been a conversation that we've been having with clients, but there are inevitably a number of interweaving factors to bear in mind, including, how the short-term pricing amendment might be perceived. Does a cost-plus pricing methodology undermine the wider transfer pricing policy? Undermine the wider transfer pricing policy in place? How tax authorities in each jurisdiction where the group is based may react. So it may well be that HMRC is comfortable receiving, getting a bigger portion of tax revenues, but inevitably that may erode the tax base from tax revenues from the IRS or French tax administration or wherever else. And then there are also local domestic factors that could be in play. So in the UK, for instance, if we were to switch from some sort of profit split methodology to a cost-plus methodology, where we have UK FCA regulated entities that are structured as LLPs, there can be implications with regards to the UK's salaried member rules. So definitely, it's really just to flag amending your transfer pricing policy shouldn't be done without giving some thought as to some of the wider issues that are in point.
Yeah, I think certainly transfer pricing is one of the subjects of discussion when trying to second guess I guess government policies in different countries. We're expecting, I guess, protectionist policies from the US and some other countries, but for the UK, Antoine, will taxes go up?
Thank you, David. That's the question is certainly an interesting one in these unprecedented times. As you rightly say, that there could be an increase in fiscal tightening globally, including the UK. We will certainly be paying off these debts for decades to come. If we touching on areas where HMRC and HM Treasury could potentially try to tighten fiscal policy in the UK, an obvious choice and one that's been tinkered with, in recent past would be, and certainly would capture headlines in the UK, would be the reintroduction of the top rate of income tax at 50% over a certain earnings threshold. But there could also be, increases in the headline rates of corporate tax could also be viewed as politically positive move as well. But although, such increases may be viewed positively politically, I think the reality is very different. I think the reality is very much the increase in tax revenues would be a drop in the ocean. So I think more likely would be that if there were increases in such policies, they would have to go hand in hand with other tax rating measures as well. A special top rate of capital gains tax of 28% is currently already in place for certain carried interest returns in residential property. Could this top rate of capital gains tax, for instance, be extended to other gains? There's also been a recent erosion of entrepreneurs relief, now business asset disposal relief. Could this erosion be extended further or eliminated entirely? Another politically sensitive regime is the UK's non-dom regime and remittance basis of taxation. The regime has obviously been with us for decades, but it's been gradually eroded over the years too. The remittance basis charge, for instance, was introduced back in April 2008 and has been extended numerous times since, making it increasingly expensive to access remittance basis of taxation for income tax and capital gains tax purposes the longer an individual remained UK tax resident. And more recently, from April 2017, legislation was enacted that meant long-term UK tax residents needed to be cognizant of becoming deemed UK domiciled for income tax and capital gains tax purposes after being UK tax resident for 15 out of the last 20 tax years. Could this non-dom regime be further eroded? Other tax raising measures could also include increased restrictions on use of losses. Certainly for banks, banks were targeted after the financial crisis to pay for being propped up and the financial support that they were given during the crisis. So could similar measures be introduced more widely? Another set of fiscal tightening measures that could be introduced could be a combination of capital tax introductions, wealth mansion taxes, for instance, a corporate equivalent of capital or balance sheet taxes or levies. But my personal view is that this isn't something that would be enacted by a Conservative government. I think it's much more likely to be, a longer-term Labour government enactment, if at all, and certainly would be a big shock to the UK if it did come to play. Also, I think the reality is that these capital taxes do create an erosion of capital base, even where a particular business might be loss-making or an individual may only have negligible amounts of income. I think personally, I think there's going to be renewed focus on tax transparency, increased disclosure, and targeted anti-avoidance measures for businesses and individuals alike. It was certainly already the trend, the direction of travel before the pandemic, and I can only see HMRC being allocated increased resources in this area to tackle tax evasion, tax avoidance, and perceived abuse.
And I guess the other school of thought is taxes can't possibly go up because we need to kickstart the economy, and with Brexit we need to be more attractive to foreign investors, and so maybe some planning opportunities around that.
Absolutely, I think you're right. As you say, on the other hand, too much fiscal tightening too soon could definitely have a detrimental impact to tax revenues, given the sheer number of businesses and individuals that are being severely impacted by the current situation. So we've just been discussing the school of thought that there may be significant fiscal tightening in the UK, and if this view is taken, then the increases in tax rates, erosion of specific reliefs and preferential regimes is likely. Some thought and analysis really needs to be given to whether or not to bring forward crystallization of gains or income distributions, and that really does create an opportunity, because effectively it's hopefully bringing forward crystallization events at lower rates. So, for instance, some UK FCA regulated companies of considerable retained earnings on their balance sheet, assuming we maintain capital adequacy requirements, could dividend distributions be brought forward to crystallise an early income tax liability for UK tax resident individual principals. Similarly, from a gains perspective, some FCA regulated companies may be heavily capitalised, perhaps over-capitalised, and assuming we can maintain the adequate capital requirements, then could there be an early capital repayment triggering some form of capital gain, giving rise to early crystallisation of a capital gains tax liability for UK tax resident principals? For non-doms, so individuals who are UK tax resident but non-domiciled individuals who are ultimate beneficial owners of these entities, if there's fear that the non-dom regime may be eroded further, would it make sense to crystallise some early distributional gain to ensure we can avail ourselves of the remittance basis regime? Given that tax administrations globally will also have the same pressures on increased fiscal tightening over the coming years, multinational groups may have non-UK holding companies, non-UK holding structures, should also consider whether to crystallise early distributions or gains as well. In my mind, however, I think there are two factors that align that certainly serve to restrict fiscal tightening in the UK and create potential opportunities of establishing a UK presence or increasing existing FCA regulated operations and substance in the UK. As we discussed previously, there is that school of thought that exists that too much fiscal tightening too soon could have a detrimental impact to tax revenues, and certainly that would be relevant to tax administrations globally. The second factor is the opportunity that presents itself to UK FCA regulated businesses in the form of a post-Brexit transition environment. Clearly, the UK and London in particular already has considerable infrastructure in place for financial services businesses. And as we approach the transition phase of Brexit, certainly in my mind, it creates a real opportunity for the British government, HM Treasury and HMRC to develop and maintain a competitive tax framework for financial services businesses in the UK, and hopefully one that's fair, transparent, and that seeks to provide increased certainty to these regulated businesses, their principals and other stakeholders alike. Certainly, if you think about the scale of the sector, such a move certainly would be really attractive to the UK's highly mobile financial services sector, who in the year to 31 March 2019 accounted for over 10% of total UK tax revenues. So yeah, it would certainly be viewed favourably.
Yeah, sorry to interrupt, Antoine. I've got a couple of questions that I'm conscious of time. There's a couple of questions that have just come in, and that interesting, that point on distributions for people that are exactly that have built up reserves is certainly a discussion I'm having with a couple of clients on is there a dividend that should be planned if people are overcapitalised to perhaps distribute before a potential tax rise. Another question that's come in specifically to LLP, well, actually there's a couple specifically to LLPs actually, I guess. Could you provide an example of how a change in transfer policy, e.g. cost plus, may affect UK salaried members' positions?
Yeah, so one of the three, so individual members of LLPs are starting point is that they are self-employed individuals, taxed as self-employed individuals, unless they meet three conditions, in which case they're taxed as salaried members. So failing any one of those three conditions would ensure that the individual is taxed as a self-employed individual as opposed to an employee and under employment tax rules. One of those conditions is that the remuneration of the individual is variable, but it's got to be variable with reference to the partnership profits as a whole. And certainly HMRC's position is that to the extent cost plus pricing arrangement is in place such that the LLP is remunerated on the basis of a markup on its cost base, then its position is that the variability of profits of the LLP, and therefore attributable to the individual, the variability of those profits are varied with reference to the cost base and not with reference to the partnership profits as a whole. So that then could mean that people who are reliant on failing condition A will need to rely on failing condition B or C in order to access self-employment.
Okay, yeah, and I guess, I mean, even irrespective of what members, as typically with cost plus arrangements, typically we see whether they're salary members or members with guaranteed draws, they tend to form the basis of included in the cost plus calculations. You know, whether they may differ in terms of the markup on those elements, but they're still built into cost plus arrangement typically anyway. So. Okay, the next point, and it makes reference to I think some time ago when Rishi Sunak stood up and was talking about the support for the self-employed. Rishi Sunak intimated that taxation of the self-employed would be brought into line with the employed to reflect the similar levels of support being provided. Our national insurance levels for the self-employed, the first tax to be adjusted, and obviously I think those that do operate at LLPs, it would be a key thing well, it would be a big issue for them.
Yeah, absolutely. I think that's right. I think inevitably, if we are of the school of thought that that there will be tax rises, there might be tax rises, then fiscal tightening and certainly alignment of national insurance for self-employment and employment could certainly be the case. So there could be an alignment there. It's certainly, it goes hand in hand, I suppose, with the long-term trend. Obviously, LLPs came about back in 2001, but certainly more recently, there's been some increased complexities that have come in for LLPs. Certainly in the form of the salary of member rules that we touched on, mixed member rules and other provisions. So it still remains a vehicle of choice, I think, for a majority of FCA regulated businesses in the UK. And certainly there are the flexibility that it offers for senior and key members of staff and senior individuals being awarded entry into the partnership. I think definitely holds true, and that flexibility will be there for a while to come. But certainly, multinational groups have perhaps tended a little bit more towards the corporate structure, so perhaps shied away a little bit from some of the complexities of LLPs. But there are different facts and circumstances that will mean LLPs are better for some businesses, some groups, and limited companies will be in the UK will be more beneficial for others. So definitely on a case by case basis.
Food for thought, and watch this space. We're running over slightly. We have a couple of questions we've not had a chance to answer, but we'll try and get back to those that have asked questions that haven't been answered. That just remains for me to thank all our speakers. Thank you to Becky for marvelous production with the PowerPoint and the cameras. Our contact details are on screen if you do have any follow-up questions. I only got caught muted once, which I think is a miracle for me. Thank you everyone for joining. Please get in touch if you want any further advice, but please do stay safe. Thank you.